just give it a head start first. So while we are still having some attendees coming in. So anyways, I'll just do a very welcome, because this is actually our very first, co-brand webinar with co-hosted by Raffles Family Office and Creative Ventures. So the theme of today is that, family office and the accelerated future of healthcare. So myself, I'm Tina Chen from Raffles Family Office. I'm the head of strategic partnership. And from Raffles side, we would have actually two colleagues, be sharing a bit of, some case study and the trends and some structure that we've been doing for our clients later on. So we have Jaydee, Mr. Jaydee Lin. He is the managing partner in Singapore. And next to him, you can see that we have Mr. Sean Tan. He is the Vice President of Business Development, and he's very good at some of the structure that we have in Singapore. And from Creative Venture side, we're very glad to have Mr. Daniel Lin as a partner, and also Miranda, Ms. Miranda Tay. She's the head of client service from Creative Venture. So before I start the introduction, I do want to say that the flow of the day would be some introduction from Raffles first. And then Creative Venture will be also, sharing a bit of what they do, some of the case studies. And meanwhile, we do have, a Q&A session after that, so that feel free to type any questions that you have during the webinar. And then at the end, we will also have a poll to be more interactive, and the results will be shown during or after the Q&A session. So to give it a start, so Raffles Family Office, we are a multi-family office, based headquartered in Hong Kong. And then actually we started the family office in 2016. After that, I think a year later, we realized that, the Southeast Asia market is something that, is important out of this. So the Hong Kong office, originally we have, to be very honest, I think 70–80% of our clients are, Chinese clients and some local Hong Kong clients. So the Singapore office basically it's been expanding quite quickly, Jaydee. I think it can sit around 70–80 people right now. That Singapore office would be mainly serving the Southeast Asia clients and some Middle East clients as well. And we also have a Taiwan office in Taipei, and upcoming actually due to COVID situation, but we do have a new office in Shanghai as well, and a rep office in Zurich. So we have 4 offices, and what we do at Raffles is that imagine we are kind of like a one-stop shop solutions, or acting as a gatekeeper for our clients. So asset management is, one key thing that obviously we would manage our clients' asset, because internally we have very experienced in investment teams. And then we realized that, by just doing, investments, it's not enough. So that we also have, license in doing insurance. And then we would offer our clients some, tailor-made solutions, trying to add values to our clients. And then we also have, some legacy planning, tax planning advice to our clients as well, which I can elaborate later. So next slides. This page will show you guys that, what do we do, traditionally. So we are, to be honest, in the past, we are heavily engaged in traditional investments with the objectives of growing and protecting the family's wealth and legacy. So in the chart that you see, that mainly we would be, in looking at bonds and equities, Asia, US, globally. And at the same time, how do we allocate our clients, assets to make it like, what we say, diversification? So we would also be looking into, alternative space, meaning we would do FX, private equities, real estate, and venture capitals, direct investment or funds as well. So yes, mainly we will allocate our assets in the development markets and traditional investments, and managed by our very experienced team, which again we can share their information or bio later. And then, so how do we manage their asset? Basically, is via what we call independent asset management model, IAM, or some people call it external asset management model. Basically, we act as the gatekeeper, because if you imagine a high net worth individual nowadays, they would not be just having, one, let's say, private banking account. They would have, 3, 5 private banking account in not just one jurisdiction. Maybe a client, they would have 3 private banks account in Hong Kong, 2 in Singapore, and then, another one in Zurich. But then, by having us, we can deal with, or manage all the accounts at the same time, and really to think or act on the best interest, or alignment of the interests of their behalf. And then, so the next slide, yes. By doing the traditional stuff, we realize that, the world and technology is changing so fast, right? And nowadays, a lot of people would, especially when we talk to the second or third generation of investors or clients, we realize that they do need some tailor-made solutions to suit each and every single family's needs. For instance, some of the family, they would have, like I said, a lot of different accounts in different jurisdictions. So they need us to be the one to consolidate their investments. And some would need our help to, structure properly how do they and what do they invest into. Some people would be in the transition of, passing the wealth from the first to second generation to the third even. So it would involve succession planning, wealth, where the insurance part, would be able to help, and some trust service as well. And some would be like, hey, I'm very good at doing my core business, but I do need, professional investment professionals to manage and provide a stable investment return for me every year. And some would be saying that, because of having a lot of different accounts in different places, what I need is a consolidated, statement to include my, hard asset, the real assets, and, the traditional assets, and maybe my insurance policies and different investment into one consolidated statement. That's all I need. So anyway, so my point is, a lot of people come to us not just for the investment parts, but really to seek for solutions. So lately, I can share with you guys that I've seen the trend of our client using fund structure. Let's say Cayman Fund, or the new VCC structure, just launched earlier this year in Singapore. To act as a mini family office for themselves. And, Raffles, because we are, also a licensed party in Singapore, very proud to say that we've been selected as one of the 20, asset manager to be in the pilot program to try out their brand new VCC fund structure. So from here, I can pass the ball to my colleague Jaydee to talk about, what is VCC structure, and then how does it help our clients.
Okay, thank you, Tina. So hi, my name is Jaydee, and I have my colleague here, Sean.
Hello.
Yeah, who will share with you about the VCC later on. So VCC is a new legal structure providing for investment funds to be domiciled in Singapore, and it was introduced on the 15th of January this year. So first of all, a VCC is incorporated under the VCC Act and not the Companies Act that we are familiar with in Singapore. And from a structural point of view, as you can see on the left, a VCC can be set up as a standalone or as an umbrella structure with multiple numbers of sub-funds. There can be as many sub-funds as you wish, and you can have both open-ended as well as closed-ended sub-funds in one umbrella structure. You can also have different regulated regimes for different sub-funds under one umbrella structure. You can have the flexibility in structuring and administering, and therefore is suitable for a wide range of investment strategies. And you can, if you set up the VCC as a standalone fund, and having only one shareholder allows for a master feeder structure for favorable tax pass-through. And now I will hand it over to Sean to explain about the key benefits of the VCC on the right.
Hello everyone, I'm Sean. So as Jaydee mentioned, the VCC is a new fund structure launched in Singapore this year. And I think one of the main benefits of the VCC is that it is very, very flexible. So it's suitable for families that are looking for different kind of solutions, be it in terms of segregation of assets, even consolidation of wealth, from different accounts, different jurisdictions. So the VCC allows for different solutions to be given to such families. And I think another point that families are very, very they're focusing mainly on is security. So as Jaydee mentioned, the VCC can be structured in an umbrella structure with various multiple sub-funds under the umbrella. So in terms of security, each sub-fund is segregated from one another. So in case anything happens to one sub-fund, the other sub-fund will all be safe. So that is important to note. And in terms of privacy, the VCC as well, it's the information of the VCC is not publicly available. So in that sense, the investors can be as private as they want. So these are the main benefits of the VCC. Of course, I can go on, but I think that would need another separate webinar altogether.
We actually do quite a lot of VCC, education, Sandler. So.
Next slide, please.
Yeah.
Yeah. So over here we have a real case study of one Southeast Asian families, and with 20 different private banking accounts in 3 different jurisdictions, and there are 4 descendants, and 2 of them are working abroad. So each of them, they have very specific needs, and they have different asset classes, investment in different asset classes, as well as over different jurisdictions. Then this is the kind of thing that we are able to help our clients, help our families to structure their wealth, to consolidate their wealth so that we have a better overview, and using VCC or other fund structure as a wealth management consolidation vehicle. Next slide, please. Yeah, so I will hand it over to Tina to talk about how do we create this mini family office under the VCC structure.
Thank you. Sure. So basically, if some of the attendees might be familiar with how does a fund structure work. So generally speaking, a lot of them would be familiar with Cayman fund structure. So basically, the VCC structure, like Jaydee and Sean mentioned, is very similar to the Cayman fund structure, and from the graph that you're looking at, it is an umbrella structure where, under the umbrella, you can set up different sub-funds. So basically, this client, very interesting. They are in the situation where the first generation trying to pass on some decision-making power to the second generation, and obviously they have businesses in Hong Kong and Singapore, and in Malaysia and Indonesia as well. So that number one, what they want us to help them do is to really form a structure where they can allocate or basically segregate different asset class, so that under one structure they are very clear of what they are investing into. So basically, sub-fund 1, so SF1 right here, it means sub-fund 1 is what they are basically their core business is about. So it's about real estate development, and they have projects in Europe, in Asia, Hong Kong, elsewhere. So this sub-fund would be manage, and actually the investment decision would be controlled by the investment committee here, the IC right there. And in terms of the investment committee, actually is basically controlled by the father, and then he would involve some of the management of his own company to sit in. And at the same time, he would, because they have like 2 kids, so they would involve the 2 kids to be, as an observer to kind of learn what's happening in terms of their core business, area. So for sub-fund 2, this is where, Raffles Family Office would be coming in, because our strength would be, again, lying into traditional investments, so that before they deploy the money to, let's say, to invest into a greenfield project, invest into, buy a building elsewhere, we would be managing their idle cash, meaning that we would basically look at some short-dated bonds and maybe some equities as well, or some structured products to generate some, short-term income for them. And at the same time, they have some cash. So they would want us to, manage that cash portion. And again, that would be the stable part. So basically, we would talk to the clients and understand what is their risk appetite, and what are the, basically, maybe some would not prefer to invest into the entertainment field, let's say. Then we would understand the client's needs and, the risk appetite. And then, so in that case, in this sub-fund 2, we have a mandate to buy into, let's say, 70% in fixed income and then 30% in equities. And then maybe would limit, some of the country focus in US and Asia. And from there, the sub-fund 2, we have an investment committee. So basically, Raffles are the one to make the investment decision here. But at the same time, we also putting one of the family members into the investment committee as well, so that they would know what's going on and they can learn from, outside in terms of, how do we look at, some of the markets. And we would have, let's say, weekly or monthly meeting to go over the investment strategy and so. And for sub-fund 3, actually is the interesting part, that where the second generation, the 2 kids, they have passions in looking at, healthcare sector and some of the, TMT sector. Basically, we call it passion projects compartment. So under this sub-fund, the investment committee is basically the 2 kids to make, investment decisions. But at the same time, it would be kind of, we are in the committee as well, so we will be able to give them some advice and to help with, some of the, let's say, the KYC or the due diligence process as well. And maybe sometimes we can meet the companies that they're about to invest together with them to ask some, right questions. So what I mean is that, like, under this VCC structure, you can set up, a lot of sub-funds with different asset class, and then each of the sub-fund, they're all segregated, meaning that one sub-fund, if, let's say the performance is not good, it wouldn't affect the other one. And then per each sub-fund, you can actually set your own rules and put, different people to basically regulate or make the investment decision under that sub-fund. And I think because of helping the clients to set up that sub-fund to invest into the alternative space, that actually how we got to, talk to creative venture as well, because I do think that in terms of, early stage investment, a lot of, our clients would be having the comments of, oh, early stage meaning is it risky? And the investment horizon, would that be like, super long or something like that? They have too much information, let's say, in the market. But then we found out that, like, creative venture with their team is their opportunity is actually quite interesting to look at. So I will pass the ball to Miranda to talk about or give an introduction of creative venture and what you guys do and how you guys differentiate yourself.
Thanks, Tina. I'd like to thank everyone again for attending this webinar. I'd first like to make a brief introduction to Creative Ventures. We're a systematic deep tech venture fund, and we focus our investments in startups that address three particular segments: rising healthcare costs, labor shortages, and the climate crisis. These are early stage deep tech companies such as AI, robotics, quantum computing, etc., operating in areas of manufacturing, logistics, and construction, healthcare, agri-foods, and energy. We mainly invest in US-based companies as two of our GPs are based there and have very deep ties to the tech and startup community, especially in Silicon Valley. However, we also have a team in Asia as well, which I'm part of. We work with Asian family offices to help them invest into and potentially collaborate with the tech startups we invest in, bring their technologies into these family businesses. I also like to introduce Dan, who will be speaking in a minute. He is the operating partner and the head of operations for Creative Ventures in Asia. He leads partnerships and client support for Taiwan, Hong Kong, Philippines, Singapore, and Thailand. He has a research background in cancer vaccine research at Johns Hopkins, and as a result, provides invaluable insights into the healthcare industry for Creative. He is also the founder of Future Ward, a startup landing pad based in Taiwan. He leverages his previous experience as an international business development executive to help startups and tech companies expand their businesses in Asia. Dan?
Dan, you're on mute.
Sorry about that. Thank you, Miranda. And thanks everyone for the opportunity to share a little bit about our thoughts around the future of healthcare. As Miranda mentioned, one of the three major themes that we focus on is the rapidly rising cost of healthcare delivery, especially in the US. This is due to several factors, one of which is the aging population in developed countries. As people become wealthier and more educated, they tend to marry later and have less children. As you see in the graph for the old age dependency ratio, the geriatric population is growing rapidly, and that growth is projected to accelerate in the foreseeable future. And as the population ages, there's a natural increase in the incidences of chronic diseases such as diabetes, heart disease, and kidney disease. And this has contributed significantly to the rising cost of healthcare. But as we can see in the graph on the right, the US is rising faster than most. This is partly due to private health insurance and Medicare systems that encourage providers to increase the number of reimbursements as opposed to improving outcomes. These problems in the healthcare system has been highlighted during the current pandemic. Right now, most diagnostic equipment is concentrated in large hospitals and urban centers, and this has limited access to those in need. As technology improves and costs are lowered, these diagnostic tools combined with remote healthcare solutions will push point-of-care testing farther out into smaller clinics and eventually into people's homes. As a result of these drivers, we see a demand for more point-of-care diagnostic and remote healthcare solutions that are more affordable than existing solutions. They will need to have low regulatory barriers, meaning Class 2 devices that only need FDA 510K clearance. That means they're existing technologies that are already in the market and only need to comply with certain factors to clear the FDA. And they need to have a large addressable market with aligned incentives between payers and providers. One example of this is one of our portfolio companies, Echo. Echo combines a revolutionary new piezo MEMS sensor with AI to dramatically lower the cost of ultrasound imaging from the traditional bulking machines that cost upwards of $200,000 to a portable device that costs only $2,000. They are expected to begin the process of FDA clearance by the end of the year, after which we expect a 5 to 6x return. As a comparable, their closest competitor, Butterfly Networks, has a portable device that also costs $2,000. And after their FDA clearance, their valuation increased by 5x. Echo has arguably better technology that provides even more detailed images that are comparable to traditional methods. If we hit our targets, this will mean at least a 40 to 50x return from our initial investments. Next, we have our newest investment, Invaria. Their AI-driven solution replaces traditional biopsies for lung diseases such as idiopathic pulmonary fibrosis. In the past, these biopsies require open chest surgery that will eventually kill 16% of the patients. Envaria's digital biopsy solution uses CT images to accurately diagnose IPF without invasive procedures. We participated in their seed round and anticipate a 15 to 20x return. These kinds of high returns are only possible in early stage venture investments. As startups wait longer to IPO, sometimes 10 to 15 years, most of the value creation is occurring in the private market. As you see from this slide of other comparable health tech unicorns, the earlier you can get in, the higher the returns. We strongly believe that Echo is on track to follow the same trajectory as these other healthcare unicorns. But with early stage investments, there's of course higher risk. So when you look at these opportunities in healthcare, you need to find a manager that has an understanding of the technologies, underlying drivers, and market dynamics. In conclusion, at Creative, we have a team of industry experts and advisors, besides myself, that have identified these early opportunities through our systematic approach. And there has been significant tailwinds from COVID-19. These secular trends will not diminish and will only continue to grow, and investors need to account for these factors in their allocation. Thank you. I'll pass the ball back to Tina.
Thank you, Dan. I think the return that you just mentioned are actually very attractive. I mean, 40x is a lot, and because I think maybe just to share, you know, from my personal experience with dealing with some of the investor or potential investors, clients, usually they would have a concern when they talk about early stage investment or venture capital. They would be like, meaning that they would immediately think of the risk because they think that unicorn, basically early stage company, it means that it has the risk of the company dying or unable to scale it up to the next stage due to the lack of product market fit or insufficient market size or funding. And at the same time, they will also involve some, execution risk, right? Basically, the business experience and so that I guess my questions, to you guys would be, how do you, when you talk about returns and risks, how do you ensure that your returns basically are repeatable, or you can deliver the returns that you are suggesting or estimating, and if the clients or potential investor are concerned about the early investment risk, and how do you comfort them?
Well, so early stage investments are inherently risky. And oftentimes people focus, a lot of VCs focus on the execution risk. But at Creative, we focus on market risk reduction using a systematic investment approach. We use a repeatable process to identify secular trends and generate unique insights using in-depth research to define investment criteria and decision rules for each of the unique opportunities. This means that we know exactly what type of investments we want to make before we even meet the founder, and can quickly and efficiently evaluate the opportunities with much deeper knowledge. This will mitigate some market and technical risk, and also sets us up for a shorter feedback loop, meaning where instead of waiting for an exit to see if our evaluations are correct, we can get feedback much faster and evaluate whether or not our initial assessment was correct, and adjust accordingly for our future investments. And another way to mitigate the execution risk is to leverage our US Asia platform to find first customers, co-investors, and other resources for our portfolio companies. So mainly just around our systematic approach on reducing risk.
Okay, interesting. And actually, I do want to congrats you guys, because based on my understanding, you guys did a recent successful fundraising, from the Taiwan side, right?
For the fund, yes. We recently was approved by the National Development Fund of Taiwan. which was a very long, arduous process, as you can imagine, with a government sovereign fund.
Yes.
So they decided to put in 20% of our final fund.
Okay, that's quite, I think to a lot of potential investor, if, a government related party from Taiwan, if you guys can pass the KYC or the DD of that, is quite assuring. So at the same time, I do want to mention that, our Q&A session is open, and then at the same time, the poll has started as well. So do feel free to ask any questions that you have in mind. I do see some questions that been asked. So some questions. So one question to Raffles. Compared to private banks, what can Raffles offer in terms of private market? That's a good question. Jaydee, would you like to take that?
Yeah, sure. Thanks, Tina. Yeah, I think it's a good question. A lot of people ask us what are our differentiators? Are we competitors to the private banks? But over here, we always say that we are working very closely with the private banks as well. But at the same time, if this question is asking compared to private banks, what can Raffles offer in terms of private market? I believe that from our point of view, we are able to access to some private club deals that private banks are not able to because of our network that we have in the various countries, especially in Asia. We are very strong. We have offices in Hong Kong, Singapore, Taipei, and Shanghai. And we also have bankers covering the Southeast Asian markets, going to Thailand, going to Indonesia, Myanmar, Cambodia, Laos, and so on. So this is why we regularly meet with all these different CEOs and some of the startup founders as well. So this is the kind of the private club deals that we get regularly. And this is why we got to know creative ventures as well.
So you mean the off-market deals, assets, and I think the entry level is rather because per my understanding, some private banking, they might have a higher minimum ticket size requirement, and maybe from outside we can be more flexible about that. And so let me take a look of the next questions. Okay, could you share the deal slides and give us a sense of the type of health tech deals that you would not do at the moment? Daniel, would you take that?
Yeah, we can share the slides later. But for the types of deals that we would not really like to do is probably things that, for example, therapeutics that will require many years of clinical testing and probably hundreds of millions of dollars. Those are things that, if the time horizon is very long, requiring a lot of investments, we would tend to stay away from that. We want to find these smaller opportunities much earlier, where they can exit in a smaller time frame, probably preferably through M&A, acquisition by one of the larger companies. And hence that's why we look at diagnostic companies, where one of these larger companies like GE, Medtronic, Olympus would probably find these innovative technologies and be able to incorporate it into their portfolio.
I see. And looking at some of the other questions, is COVID-19 accelerating the growth of healthcare startups? Daniel?
Yes, definitely. Especially in telemedicine and also diagnostics. You can see in the US, they have a lot of issues with testing or lack thereof. So there's been a big tailwind for those startups and for the ability to provide healthcare with remotely without human interaction. And this has actually not only helped put a tailwind to our healthcare investments, but also our AI automation investment, as people are looking to have less interaction. So this is for most of our portfolio that we've actually benefited from the current situation.
Okay, thank you, Dan. I see questions related to VCC right there. Sorry, could you please quickly explain how VCC help manage my investment? So I'm not sure what kind of investment would that be. So I think Jaydee, maybe in a broad, high level, could you touch on that?
Sure, let me take this one.
Sure,
So,
Sean.
as we discussed previously, the VCC actually is really flexible. So in terms of restrictions, we don't have any restrictions based on investment types, as long as it's under the collective investment scheme, which all normal investments fall under. So any kinds of investments mostly would be able to be taken under the VCC structure. So a few main reasons or methods that our clients have explored using the VCC is a segregation of different asset classes, as we shown in the slides just now. So that's one of the main kind of options that the clients use to structure their investments, or they can use it to allocate it to different, even family members, So one, this investment type would fall under, let's say, the first child, and then the second one would be under the second child. So there are different ways you can structure it. It's very flexible. So depending on your needs and your investment types, we can go into greater detail.
Sean, and actually to touch on that part, because I remember you are currently handling a case where a client would like to use the VCC structure basically to put like we mentioned before, different asset type, and at the same time he's also getting an employment pass as well. So could you share a bit more on that as well?
Sure. So along with the VCC, there are actually a few different schemes that the Singapore government has promoted, mainly based for tax exemptions, so tax benefits in terms of investment. So, and along with those schemes, it comes employment pass. So these families or individuals can come to Singapore on the employment pass to work here, to run the fund essentially, and then to manage their investment. So that is another option that some clients look at, to start sort of a business or a family office, if you will, in Singapore. Mm-hmm. So they explore different structures. So the VCC is one of them. Yeah.
Yeah. Upon getting the employment pass, about 1 or 2 years later, you can apply to become the Singapore permanent residents. You can submit the application to become a PR. Yeah, but it doesn't say guaranteed or not. But of course, there's a way to submit to get a PR.
Interesting, because I think those would be quite the benefits of one of the benefits of setting up VCC as well. So let me look at the questions quickly. Maybe we can have some questions to ask a creative venture. So there continue from the attendee's previous question. Will telemedicine become a long-term thing or just a solution during the global crisis? Daniel, what do you think?
We anticipate telemedicine to continue to grow beyond COVID. What the current pandemic has actually removed some of the restrictions and regulations. For example, the U.S. government has removed some of these barriers, and the market has basically developed probably more in the last year and in the last 10 years. So it's a rapidly accelerated adoption, and it's just getting people used to triaging and kind of doing initial assessments through this method. So we anticipate this to continue to grow and expand as people see the value in remote telemedicine.
Thank you, thank you. I hope that answered one of the questions. So next question I see. So what's the average time required to get the VCC up and running?
Yep. So actually, the VCC, as Jaydee mentioned, there are actually two options. So one, you set up a standalone fund on your own, or secondly, you could join in under the umbrella structure. So just join in as a additional sub fund. So of course, if you join in under an existing umbrella structure, it's pretty much straightforward. So I think just on average, you could do it within a couple of months, right? You could set up, draft the documents, launch a strategy, deploy the funds. I think within 2 months, that's quite a safe bet. But if you were to set up your own kind of umbrella or your own standalone master fund with your own constitution, your own your own kinds of rules, your own documentation, that would take a little bit longer. Maybe 3 to 4 months would be a safe bet. Especially in such uncertain times, I think 3 or 4 months is quite safe. That's up and running.
Yeah, maybe I'll just add on to that. So just now, as Sean mentioned, you can either incorporate under the umbrella fund, set up a brand new umbrella fund, or incorporate under a sub fund under an existing umbrella. But another way is VCC can also allow redomiciliation. So if you have an existing fund structure in other jurisdictions such as Cayman, BVI, Luxembourg, Seychelles, Mauritius, etc., you can actually apply for an redomiciliation to Singapore. And Singapore has already made this process very streamlined. Yeah.
Sean, you just mentioned 3 to 4 months, right? Did I get it right?
So to set up your own
a brand new one belongs to themselves. Okay. Because some of the clients might find that it's quite a long, rather long period of time. They might need a structure quite immediately. I believe that we actually have a client to set up a fund within 2 months time, right? Including the corporate, the bank account opening for the funds itself, right? I mean that could be the case as well.
That's the best.
Yeah. Okay. Let me see. So how risky are the early stage investment? I think Dan has briefly touched on the risks before, right? Would you like to further elaborate on that? Otherwise, I do personally have a questions for you guys.
Well, yeah. Again, inherently, early stage investments are very risky. So this really depends on the individual's risk appetite. But we believe that there needs to be at least a certain amount of allocation to take advantage of the high returns that are possible, that are only possible now in early stage. And if you wait until they get into the public markets, then you're looking at the low digit growth versus early stages, it's multiples.
So my turn. Can I ask question again? So I do know that you guys have quite a good track record. Because I think around 1 or 2 years ago, when I talked to Drew and Champ, I do know that they have already closed their Fund 1. So how's the performance so far for Fund 1, and what's the difference or strategies in terms of strategy? What's the difference between Fund 1 and 2?
Miranda, would you like to take that question?
So I would say pre-COVID, our Fund 1 performance is probably around the, I would say, mid-20s IRR. Now, obviously, but obviously COVID had some impact on some of the valuations. So I would say COVID's impact on our portfolio's performance is basically twofold. One is delaying milestones, and 2 is actually delaying some of the fundraising. Now, we did an assessment of our portfolio companies, and luckily for us, actually almost all of them have at least 1 year's runway. So, luckily for us, we didn't have to actually go in and rescue any of them, and they will definitely pull through this. But I think it's probably hit down at IRR maybe about to, I would say, single digits now. But we expect that to rebound aggressively, maybe in the second half of this year.
Okay.
Yeah, and then also the difference between Fund 2 and Fund 1 is that we expect Fund 2 to be, well, it's larger in size. So Fund 1 was about $16 million in total. We expect Fund 2 to be around 40. So our check size will be about, probably about 3 times the size, from 250 to 750 for this Fund 2. We are still early stage, but probably more Series A than seed.
That's actually a good number because so what's the duration of the fund? So the Fund 2, when, so question number 1 is when would the Fund 2 be closing? And then second, what's the fund duration?
Right. So Fund 2 will be closing, I believe, August of next year. So we still have a bit of time. Okay, so there's a bit of time. And duration is the investment period is about 3 years, and the total fund period is about 10 years and 1 + 1. But we hope to, since most of our investments are in B2B companies, we actually hope to exit early. So no need to wait for an IPO. We're aiming to exit within 5 to 7 years of investments. Yeah.
Gotcha. Okay, so by the way, just to mention that, like, we also have a poll going on. We have some questions, right? So maybe we can go through the questions right now because we don't have much time left. And by the way, we do intend to have a physical event, you know, later on to do with again with creative venture, to touch, I guess, more in depth in terms of, you know, the solutions that we can provide, and some insights on not just healthcare, but you know, other industry, because I think creative ventures, you guys do, you know, look at some opportunities in terms of like a climate change related, or, you know, AI robotic related as well. So let's check out the questions. Okay. I guess the poll is not ready yet. Okay, 5 minutes to go.
No problem, Tina.
Okay, sure. We can keep doing the Q&A first then. The segregated portfolio under the VCC structure can be managed with and without professional investment manager, Jaydee and Sean?
I think that's very straightforward. It has to be managed by a licensed professional manager. Yeah.
Yep. So we work in partnership with the investor or the client to launch the fund. So yeah, we will be working with the, you know, the regulated entities such as the MAS in Singapore and ACRA in Singapore as well. So yeah, we will be dealing with them on behalf of the clients.
Yeah. So one has to be licensed to set up the VCC structure. So having said that, a single family office who does not have a license with the MAS is not allowed to set up the VCC structure at this moment.
Got it. Okay. And last question, what's your AUM as of today? I'm not sure it's, to Raffles.
Well, that's a very straightforward question.
Very straightforward.
Question, yeah. I mean, if you, in the past, we used to disclose the size of our AUM. If you look at the press release in the past, and also on our website in the past, that we had $2 billion US. But because right now we do not want to disclose the number anymore, and of course, like, you know, over time we have grown to a more size AUM. Yeah, but of course we have a bigger target. Until we hit a bigger target, then we'll make the announcement. So we do not wish to, you know, increase the.
I think if some of the you know, attendees would be interested, they are feel free to look at, you know, the annual flagship events that we've done last year, right, at Hong Kong Exchange. we've been mentioning about our AUM target and some of the numbers. So feel free to have a look at that. You have a better understanding. So meanwhile, there's not much time left, so that I'll just quickly share with the the poll results here. So right now I'm seeing that we have 4 questions in total. And number 1, which fund structure would you use to manage your investments? I see that, interestingly, some people picked, 54% of people picked a VCC, 54 people picked BVI, and how come the number doesn't add up? And some would use, a Cayman. Okay, so very interesting. I think from our side, Raffles clients, I would say that it used to be mainly, using a Cayman structure, to be honest. And then lately, I've seen the changes and the shift to VCC as well. And some people will still prefer Cayman for the real estate projects or property projects, and then some, they would prefer the VCC for maybe the employment pass, or the tax benefit and so on. So number 2, what is your main concern for investing into early stage tech deals? 8% have voted, attendees have voted their lack of understanding of the technology. 31% lack of understanding of the market and technology application. And most of them are, concerned about the risk of company failing along the way, which is exactly, I think, very common. That's one of the biggest concern from our side as well that we've seen. Number 3, and by the way, hopefully Dan has, well addressed the questions about, the risk of company falling along the way. So number 3 questions, how likely are you to explore family office or IAM space in the near future? 62% says that it's highly likely to do so. From Raffles Family Office perspective, we do see the trend of, the independent asset management, or so-called EAM family office space. The trend is always going upward. And later on, I think we would be hosting family office forum in maybe Hong Kong and Singapore as well. So we'll keep you guys posted. So last questions. Have you ever made any investment into the healthcare sector before? Most of them, they said that yes, they have invested in healthcare via direct deals. Some would say that they have into healthcare fund. And I do understand from, the investors' perspective that they like to pick the deals that they like, right? And some of the investors, they like to diversify, meaning that investing into a healthcare fund, they are able to, basically enjoy the benefits of multiple companies' growth and so. So I guess that's the result of end of the pool session. The next page that I think we can show some of the contact details. Is it going to show on the slides? Okay, the next page that you'll be able to see some of our contact details later on. And as I mentioned before, we will be doing some physical events in the future. Hopefully the COVID situation will get better, and I wish everyone stay safe and healthy. And Daniel, Miranda, anything to add from your side?
No.
Thank you.
Thank you.
Great. Thank you everyone for joining. And we will be, we have recorded this session. And if you want to look at the whole video again, we will be sending the thank you link or like a link, a video link, or via Raffles Family Office website as well. Thank you everyone. Hope you enjoy the session and have some takeaway. Thank you.
Thank you.
Bye.